In this video, I want to speak about stop hunting and why the biggest banks, so basically the market makers, are actually hunting the stop losses every day. Because there are some very specific reasons for which they actually do this, and that is exactly what I want to explain in this video. Now, if you're new to the channel, I'm a top author on the trading platform and I share free education and analysis every day on all my platforms, so I suggest you subscribe so you won't miss out on all this free education, and I will see you in the video. Okay, so as you guys requested, what we will be doing in this video is speaking about stop hunts, market maker manipulations, and fake breakouts. This is basically the three ways in which market makers actually manipulate the market, and obviously I will be explaining to you guys why they need to actually manipulate the market and hunt your stop losses. And also what I will be doing in this video is obviously, as I just said, first speaking about these concepts, and then I will also give you a full breakdown of the situation that currently we have on eurchf. And by the end of the video, you will know exactly what kind of opportunity we can be looking for on this pair in the future. And as usual, I will keep also the analysis very educational so that you will learn exactly what you have to be looking for when you're actually analyzing the market. So make sure you stick to the video until the end because there is a lot to be learned in the video. So let's start first from speaking about market maker manipulations, stop hunts, and let's first start by explaining why in the first place market makers need to actually manipulate the market. Now this is a very basic concept, okay? For every buyer in the market there has to be a seller. Now market makers have, and hedge funds in general, have so much money to actually manage that while for us it's very simple to just click buy and we can buy, they actually have to generate the liquidity to actually buy. Meaning that when we buy, some of us don't even trade on the real market. We trade CFDs, so we don't even trade on the real market. But even if you are trading on the real market, it's very easy for you to buy because there will always be enough sellers for you to actually buy your contracts. However, the big banks and institutions don't have in the market enough sellers if they want to buy. And same thing, if they want to sell, there aren't enough buyers at that specific time. So what do? They actually generate those buyers. Let's say they want to buy. What do they need? If they want to buy, they need sellers. Now, if there isn't enough liquidity, there aren't enough sellers in the market when they actually want to buy, what they can simply do is basically go and hunt stop losses. And a stop loss, if you're buying, is simply a sell order. So if they trigger these sales of retail traders, what will happen is that they will have the liquidity to actually buy because all those stop losses are actually sell orders. And those are exactly the orders that they need in order to buy. So let's say, for example, what the market created here. Okay, let's take this move here. Now, clearly institutions wanted to buy because we knew, and the market did, we already know this, the market did create this move to the upside. So this impulse and correction needed to be an impulse correction and continuation pattern to the upside. However, why did the market not simply create an impulse correction and continuation to the upside? Why did we have impulse correction? The market tried going higher, broke back down, and then the move to the upside. Why did the market create this pattern instead of this pattern here? Now, the reason for which the market created this pattern here, which obviously is this one here, is because market makers didn't have enough sellers to actually buy. So what did they do? Let me explain to you what they had to do in order to create this move to the upside and to actually buy. What they had to do is trigger all stop losses that were below this area, okay? Now, follow the psychology of the market here. We had this impulse to the upside. Okay. After this impulse, the retracement followed. Now, after the impulse and retracement, the market tried to basically go back to the upside and complete the pattern for an impulse correction and impulse pattern to the upside. Now, what do you think most retail traders did when the market was looking like this? when you had a clear impulse correction and it clearly seemed like the market wanted to continue higher. What they did is most of them started buying, okay? Without looking for confirmations on lower time frames, they just buy, okay? Because they say, okay, impulse correction, the market already tried to go higher, so definitely we can be looking for the continuation to the upside. Big mistake. Because what is this? This is a simple trap. Impulse correction, everybody starts buying. Where is the stop loss? Everybody will put their stop loss below this low. That is basically what most trading books will tell you to do. They will tell you, okay, if you want to buy from here, your stop loss needs to be somewhere below this low here. And what the market did. Now, the way in which the market makers manipulated this market is very simple. In this case, they simply needed to bring price back to this level, hunt all the stop losses that were below this low, and then create the continuation to the upside, which is exactly what the market did. The market went to hunt all the stop losses that were below this low, and then at that point, after they had hunted the stop losses, all those stop losses gave market makers the possibility to actually buy because all those orders were sell orders. And at that point, they can buy, and that is exactly what the market did. This is basically how market makers, in general, okay, how market makers actually manipulate the market. Now, obviously, there are many types of manipulations. If I were to speak about all of them in this video, it would be like 2 hours video. So I just wanted to explain the concept and how market makers manipulate the market and why they actually do it. Now, obviously, now we will make the analysis of eurchf, but I will also explain the latest manipulation that market makers created, because this is another type of manipulation. Now here, we had this huge impulse to the downside, okay? The market clearly was rejecting the monthly resistance area that we have here, which I will now speak about in more detail. So from a long-term perspective, we can expect a move to the downside. However, what most retail traders did after the market created this huge rejection to the downside. After this candle, many of them for sure have shorted. Where is their stop loss? Their stop loss is simply above the high. You don't need insider information to understand this. Simply their stop loss will be above this high. And in fact, the market went, hunted all the stop loss, all the stop losses with this spike to the upside. And then at that point, market makers had enough liquidity to actually start selling. This is basically how market makers manipulations work. Now let's make a full breakdown of the situation that currently we have on eurchf. Obviously, we will check the monthly, weekly, daily time frame. We will also see what we have from a COT perspective. So what the biggest banks and institutions are currently doing on the pair. And we will see what kind of opportunity we can be looking for on this specific pair. Just a quick reminder, make sure you comment below and you let me know which pairs or topics you would like me to analyze or cover in the next videos. Now let's start from the monthly time frame. Now on the monthly, clearly we have a market that has already tested a very strong level of structure. In fact, we have very strong previous support here on the monthly, which has now turned resistance inside of this area. Now, if you want information on a retracement in the market after an impulse, you have to take your Fibonacci on the impulse. And by taking your Fibonacci from the high to the low of this monthly impulse, what we can see? We can see that the market went for a perfect test of the 0.618 Fibonacci retracement, which is the Fibonacci level aligning the best with this previous support, not on resistance, and the market tested and already rejected this area to the downside. And after this rejection, we can definitely expect more continuation to the downside. So on the monthly, we have confluence of resistance inside of this area given by the 0.618 and the previous support on resistance. Going down the weekly, what do we see? Now on the weekly time frame, we can see that the market tested this area multiple times. It continuously creates rejections of this supply area, from which we definitely expect more continuation to the downside. So on the weekly as well, everything is pushing down. We go on the daily, and what do we see? Now from a daily perspective, we can see that currently the market is starting to create a bullish pattern. Which is this bullish pattern? The pattern is this M formation. Now after an M formation in general, what do you want to see? You want to see the market give you a move to the upside to go and test the neckline, aka the previous support, which is now to resistance. So here from a daily perspective, after this M formation, we want to see the market give us a move to the upside to go and test this previous support, now turned resistance. What we can also notice is that this area here is a very strong level of demand, from which all these spikes to the upside actually started. So institutions like to buy from this level, which is exactly the zone that we can be looking for a potential opportunity on EURCHF. Now, from a higher time frame perspective, as we said, we want to see the market go lower. However, we know that from here we can expect a retracement. So how we will be approaching this situation with students. Now, before I show you that, let's first go and give a quick check at what we have from a COT perspective on the euro and on the CHF. So what the biggest banks and institutions are currently doing on these two currencies. So how are they positioned in the market? Now on the euro, we can see that with the last report, institutions closed 11K longs and opened 3.8K shorts. Now we have a new report coming out tomorrow, which definitely will help us understand better what is going on at the moment on the euro. But clearly in the long term, we have seen an increase, massive increase in the net positions from minus 114K to plus 196K with 250K longs and 54K shorts. So in the long term, euro has been extremely bullish. However, we start to see some profit taking from an institutional perspective on all these longs, which could lead to some short-term weakness of the euro. And if we go and see what we have from a CHF perspective, what we can see that net positions went from 17K to 11K with 1.1K shorts added with the last report. However, at the same time, we also have some longs getting added after 2 weeks in which longs were getting closed. So we start to see again some longs getting added. Now it would be great to see with the new report more longs getting added, something that we will be looking for tomorrow. So at the moment, situation is extremely clear. We're having some profit taking and there is the possibility also on the CHF to see more longs getting added. So what we will be doing is, as usual, is being reactive in the market and not predictive. So what we will be doing now, after the market will make this move to the downside and go and test this demand inside of this area with students, we will be monitoring price action from a 4-hour perspective. Why 4 hours? Because monthly, weekly, and daily combined with the COT data are the best time frames when it comes to the direction of the market. But the best time frame for entry is the 4 hours. So with students inside of this area, we will be monitoring price action from a 4-hour perspective, waiting for the market to shift from a bearish market to a bullish market. And if the market will shift from a bearish to a bullish market and provide to us one of our valid entries, we will be taking a nice long with a very good risk to reward and very good probabilities for the move to the upside and for the market to actually complete this information at the neckline. And after that, obviously, we will be ready for the continuation to the downside and for the market to actually break below this structure. But first, we would like to see this daily formation actually complete. If you enjoyed the video, make sure you smash that like button and comment below. It really does support the creation of more free education and analysis for all of you. Also, make sure you go and check out the mentorship program. You find it linked in the description. You first learn all the rules of my rule-based strategies in the program, and then you trade them live with me. In fact, every single day you get a new daily market breakdown showing you exactly how to apply the strategies with entry, stops, take profits, as well as having me answering every single question that you have every day, including the weekends. So I really suggest you go and check it out. The link is in the description, and I will see you in.